Hey there! Let's go over 25 of the most common business and finance terms that you need to know to communicate more confidently in the workplace. The first one is portfolio. A portfolio refers to a group of financial assets that an individual or institution owns. Some examples include stocks, bonds, real estate, and other forms of investments. Liquidity. Liquidity refers to the ability to convert an asset into cash without losing value. Examples of highly liquid assets include cash, checking accounts. Less liquid include real estate, equipment. Volatility refers to the degree to which the price of an asset changes over time. High volatility means frequent and significant price changes. Low volatility means stable prices with fewer fluctuations. Hedge. A hedge is a financial strategy used to protect against potential price changes. Example actions might include buying options or futures contracts to minimize the risk. Index. An index is a statistical measure that tracks the performance of assets, such as stocks, representing a particular market. Some examples include the S&P 500 and the Nasdaq Composite. Diversification. Diversification is a strategy of investing in a variety of assets to reduce the risk of loss. For example, an investor may hold bonds, real estate, and stocks instead of relying on only one type of asset. Margin. Margin refers to money an investor borrows to buy securities, using the securities in their account as collateral. For example, if an investor owns $3,000 in cash, they can borrow another $3,000 on margin and invest a total of $6,000, with their own $3,000 serving as collateral. Yield. Yield refers to the income return on an investment, expressed as a percentage of the investment's cost or current market value. For example, if you buy a bond for $1,000 and it pays $80 in interest annually, the yield is 8%. Leverage. Leverage refers to the use of borrowed funds to increase the size of an investment. For example, suppose an investor has $5,000 and borrows another $15,000 to invest a total of $20,000. This magnifies potential gains but also increases risk, making it a high-risk strategy. Market capitalization. Market cap refers to the total value of a company's outstanding shares. For example, if a company has 5 million shares outstanding, each valued at $30, then its market cap is $150 million. Mutual fund. A mutual fund is a form of investment that pools money from multiple investors to purchase a diversified portfolio of stocks and other securities. For example, if $1,000 is invested in a mutual fund, the money might be spread across different types of securities. Instead of owning a specific stock directly, the investor owns shares of the fund, which represent a slice of the entire portfolio. Exchange-traded fund. An exchange-traded fund, ETF, is an investment fund that holds a collection of assets and can be traded like individual stocks. ETFs combine the diversification of mutual funds with the flexibility of stock trading. Derivative. A derivative is a financial instrument that derives its value from an underlying asset. Common underlying assets include stocks, commodities, bonds, currencies, interest rates, or market indices. The main types of derivatives are options, futures, forwards, and swaps. They are widely used for hedging risk and managing exposure to price fluctuations. Options. An option is a contract that gives the holder the right, but not the obligation, to buy or sell an asset at a specific price, called the strike price. A call option gives the right to buy the asset at the strike price. A put option gives the right to sell the asset at the strike price. For example, if you buy a call option on Company A stock with a strike price of $40, and the stock rises to $60, you can buy it at $40 and sell at $60, making a profit. If the stock stays below $40, you don't exercise the option and only lose the premium paid. Benchmark. A benchmark is defined as a standard or index used to measure investment performance. It helps fund managers and investors evaluate whether their portfolio is performing better or worse than the overall market or a specific sector. Venture capital. Venture capital is a type of financing provided to startups and small businesses with high growth potential. Investors, either wealthy individuals or venture capital firms, provide money in exchange for equity, ownership, in the company. Dividend. A dividend is a payment made by a company to its shareholders, usually from its profits. Dividends can be in the form of cash or additional shares in the company. They are a way for some companies to share their profits with investors. Risk premium. A risk premium is the extra return investors receive for taking on risk compared to risk-free investments. It is a form of compensation to investors for bearing uncertainty, volatility, and potential loss. Alpha. Alpha measures the excess return of an investment compared to its market benchmark index. It shows the value a specific strategy adds beyond what the market itself delivered. Arbitrage. Arbitrage is the practice of buying and selling assets simultaneously to profit from price differences. For example, if a stock is traded at different prices in two markets, a trader might buy it in the lower price market and sell it in the higher price market, pocketing the difference minus transaction costs. Bull market. A bull market refers to a period when asset prices are rising, commonly accompanied by investor optimism. It mainly refers to stock markets, but can also include bonds, real estate, or other assets. Blue chip stock. Blue chip stocks refer to shares of large, well-established companies with strong financial performance. Companies like Apple, Microsoft, or Johnson & Johnson are considered blue chip stocks due to their size, stability, and consistent track record. Over-the-counter, OTC. OTC trading refers to transactions that take place outside of formal exchanges. For example, investors buy and sell securities through brokers rather than on centralized trading platforms. Securitization. Securitization is the process of combining a group of financial assets and converting them into tradable securities. It involves pooling many small, illiquid assets and transforming them into marketable securities that investors can buy and sell. Market order. A market order is an instruction to buy or sell immediately at the best available price. It prioritizes immediate execution over price precision. That's all for today's finance and investment terms. Thanks for watching, and see you in the next video.